Hello everyone, we are from Trend Surfers and this is a basic learning video for all our subscribers and for all the traders in the market. There are some basic rules that we should all follow. I will start off with position sizing. So when we all enter the market, we all have a fixed capital. Suppose we start with 10,000 rupees of capital. Now the basic rule is that in a single trade, we should not risk more than 2 to 4% of our capital. Now suppose I have 10,000 rupees of capital and I follow a 2%. So this is up to you whether you follow 2, whether you follow 3, whether you follow 4. That's up to you. But this is the general rule, 2 to 4%. Suppose I follow a 2%. I will not risk more than 200 rupees, which is 2% of 10,000 rupees. Now any trade that I take, I will lose maximum of 200 rupees. If it goes and hits my stop loss, I lose 200. If it goes and hits my target, I make money. Now, to calculate the quantity to have a 200 rupees of loss, maximum loss, I should know how much quantity should I buy or sell. Now, suppose my entry price is at 100 and my stop loss is at 95. This means if my stop loss gets hit, I make a loss of 5 rupees per share. Now, if I want to make maximum loss of 200, if it hits my stop loss, I should know how much quantity should I buy. So if I take 200, which is the max loss from here, divide by entry price minus stop loss price. That means 100 minus 95. I get 200 divided by 5, which is equal to 40 quantity. That means if I'm entering this stock at 100 rupees, I should buy 40 quantity so that if it goes and hits my stop loss at 95, I make maximum loss of 200 rupees. Now, this is with regards to position sizing. Now, this 40 quantity is not a fixed amount. Now, suppose this was 100 and 98. 98 is entry, 100 is entry, and 98 is stop loss. That means I should take 200 divided by 2, which is equal to 100 quantity. Now, as long as we follow this quantity, this position sizing, how many more times my stop loss gets hit, I will make only a loss of 200 rupees per trade. Okay, but now suppose I enter at 100, stop loss is at 95. Now there should be something called risk reward. That means if I'm risking 5 rupees, the risk is 5, so my reward should at least be 10 rupees. That means I should make at least a risk reward of 1:2. Only if my target is at 110, then I will enter. Because not everyone has 100% accuracy. In fact, no one has 100% accuracy. There will be stop losses, there will be losses, and when your stop loss gets hit, you should exit. So nobody has 100% accuracy. People normally have a 60 or 70% accuracy. Now, as long as you follow a risk reward and the position sizing, you will make profit. Now let me explain with the help of an example. Suppose there are 10 trades, 10 trades, and we have a 60% accuracy. So 4 will be profit, 6 will be 4 will be loss, and 6 will be profit. So if I take 4 into 200, which is 2% of my capital, I will make a 800 rupees loss. 800 loss. Now, if I make 6 trades and I follow a 1 is to 2 risk reward, that means I will make at least 400 rupees in these trades. And if I take 6 into 4, which is equal to 2400 of profit. So if you see, I still have an overall profit of 1600. This is only because I followed a 1 is to 2 risk reward and I was able to maintain a 60% accuracy. Now let's change this to 50% accuracy and 1 is to 2 risk reward again. Now 5 profits are loss, I lose 200, and 5 profit are 5 trades are profit. Now what happens is I lose 1000 rupees here, but here I make profit of 2000. So even with a 50% accuracy and 5 loss trades and 5 profit trades, I am making 1000 profit. That's why risk reward is one of the main things in the stock market. So 1 is to 2 is just for starters that you should at least try to get. Anything less than 1 is to 2, it's not even worth the time and effort and the risk that you're taking. Because if you're risking 200 and you're going to get a possible profit of only 100, then it doesn't make sense. Why should you risk 200 to get a small profit of 100? At least if you're getting 400 or 600, then it makes sense to take the trade. This is called position sizing and risk reward. Now, some more psychology or trading rules that we should follow is, first of all, when your stop loss is at 95, suppose this stock we took at 100, from 100 it came to 95, to 98, 96, and it's almost going to hit your target, your stop loss of 95. Your stop loss is already placed at 95. Don't move the stop loss down. Don't reduce it. Because if now you remove the stop loss and you change it to 93, you have already bought 40 quantity. Now if you reduce your stop loss to 93 from 95, now your risk is 7 rupees into 40, which is equal to 280 rupees risk. Whereas we should be taking a max loss of only 200 rupees. So that's why never move your stop loss when the trade is going against you. If suppose this trade went from 100, it went to 105, what you can do is, to reduce the loss or the possibility of a loss, you move your stop loss instead of 95, now you keep it at cost at 100. Now what will happen is, even if the stock doesn't go till 110 and instead it starts falling down, your stop loss is now at 100, and if it hits your stop loss, you will exit cost to cost and you do not make any loss. That's how you play a game very smartly, so that the possibility of loss is reduced and the possibility of a target is increased. That's how you maintain your risk reward, and also the probability of a profitable trade. Now, one more thing that most people don't follow is number of trades. Unless we are a scalper, we shouldn't be taking many trades. Maximum, we should take 4 or 5 trades in one day on a intraday basis. The reason for this is, if we have multiple trades, if we are having like say 20 trades, 30 trades, what will happen is our mind gets exhausted and we are not able to concentrate on every trade with a clear mind, especially when the initial trades become a loss. What most people do is they take revenge trades to recover that earlier loss, and sometimes they end up with even bigger losses. That's why we should have maximum 4 or 5 trades in a day, and we should not do over trading. Try to reduce the number of trades and take only high probable trades. Analyze everything before taking the trade, and only if the trade looks good, giving you a good risk reward, then take it. And don't take multiple trades, because if your mind is diverted between 2 3 trades, you cannot concentrate on any of the stocks, and you won't be able to make good profits normally. Try to take only one trade at a time after a good analysis, and you're able to check everything. One more thing about risk reward is that people should follow. If it is stocks, this is minimum. Okay, the higher it is, the better for you. For stocks, it is 1 is to 2. For option buying, it is 1 is to 3. And for option selling, it is 1 is to 1. If you are not getting this much minimum, then the trade shouldn't be taken. I sometimes take trades in stocks with a 1 is to 3 or a 1 is to 4 risk reward. So what happens is, even though I make some losses, one profitable trade recovers as good as so many losses that I had in the past. If I had if I'm risking 200 and I lost 4 lost trades, I make loss of 800. But if I have a risk reward of 1 is to 4, that means I get 800 in a single trade, and one single trade recovers the loss of 4 lost trades. So I just need one profitable trade to recover 4 stop losses. Now obviously my accuracy is not going to be 25% or 20%. I will have a good profit risk reward and a accuracy to be profitable. That's how most profitable traders survive in the stock market and are able to make consistent and good profits at the end of every month on a constant and consistent basis. I hope this learning video was good. To learn more from us, follow us on all our platforms: Telegram, Facebook, Instagram, YouTube, and learn with us and then earn in the future from stock market. Thank you. Made with love by Trend Surfers.